I'm Scott Starratt with Starratt Wealth Management, part of Canaccord Genuity Wealth Management. Today, we're very fortunate to have Sean Kallir, who's the portfolio manager, CEO, and CIO of HGC. So Sean began his investment career in 2011 as a merger arbitrage and special situation analyst at a hedge fund in Toronto. He has well over 9 years experience, been involved in hundreds of SPAC and merger arbitrage positions. And by the way, we're going to talk about what all that means today. And is very, very well versed in the nuances of special situations. He's a founding partner of HGC and has a BA in honors in economics from the University of Western Ontario. So thank you very much, Sean, for being available for this.
Yeah, thank you, Scott.
So let's get right into it. And why don't you share with us how you started HGC and how you got into the business of managing money for people?
Yeah, sure. So, the real thought process when we launched HGC was a very well-defined narrow investment mandate. 7.5 years ago, we thought that the days of maybe the super fund or the multi-strat do anything type fund, we thought that was coming to the end of its life, and that investors were looking for more narrowly defined investment mandates. Our thought process was always, if we want to run multiple mandates, they should be inside of separate funds, not inside of one fund. So that was kind of the founding principle when we launched HGC. My background, Dave's background, the other also founding partner, and then Brett's not on the investment side, but was in merger arbitrage and risk arbitrage. So we launched with a thought to have a solely focused risk arbitrage fund. And that's what we did in June 2013. Post-launch, SPACs have become a very nice complement with the same features as risk arbitrage: defined downside, defined timeline, low volatility, nice ability to protect capital. So that's kind of how the strategy has evolved to now become a risk arb and SPAC fund, and quite honestly, it's more SPAC than risk arb, as you know. It's 90% plus SPAC, and that's really just a function of the opportunity set since we've launched.
Cool. So we've each mentioned SPACs a couple of times now. So what does that stand for, and what is a SPAC?
Yeah, sure. So SPACs are getting more and more attention in the financial press. Certainly, it seems they're talking SPACs daily on CNBC now, or new Barron's article or Wall Street Journal. So a SPAC, the acronym is Special Purpose Acquisition Corporation. And what a SPAC is effectively, it's a blank check company. So a sponsor group will go to investors like ourselves, raise capital that will then sit in a segregated trust account for up to 2 years, while they will then look to go deploy that capital into some sort of transaction, a merger with a private company. There's a lot of nuances about the SPAC structure, but I think the key points to remember from an investor's point of view is your capital, your principal is never at risk. So the capital that you fund on the IPO sits in a segregated trust account. The management team of that SPAC has no access to that capital. And the way that capital leaves the trust account to then go into the pro forma business is there's a shareholder vote. And coinciding with that shareholder vote, there's a redemption right. So as a SPAC investor, you're never beholden to the transaction that the SPAC sponsor brings. You always have the right to get your capital back from the SPAC, which is going to be, SPACs are issued at $10. So it's going to be $10 plus your pro rata portion of the interest that is accrued in the trust account. So it's a very investor friendly structure, and a structure that you can generate, really nice returns with some really nice upside tails. Certain strategies have negative tail risk, and SPACs not to say there's not any risk. There's some liquidity risks and things like that, which we saw, in March. But you have an upside tail of when they announce a transaction, you don't have to make your redemption decision that day. You actually have 3 or 4 months for the SPAC to trade as a publicly, it always is traded publicly, but that 3 or 4 month period will trade as if it's a pro forma company. So you actually could have a scenario, DraftKings is a great example, or Nikola, where public market investors value this transaction far in excess of $10. So maybe instead of redeeming at $10, you're in a position where you can sell into the open market at 15 or 16 or 20. So you have this really nice upside tail along with certainty and preservation of capital.
So, just to go from that, if you end up in a situation where you don't like the deal, you can therefore just vote and get your money out at that point?
Correct. Yeah. If you're negative on the transaction and they bring that transaction to a shareholder vote, it's actually a bifurcated vote and redemption right. So whether you vote yes or no, which SPAC investors typically always vote yes, it's not really in our interest to vote no, because you want to see the deal consummated regardless, even if that just means you get your redemption proceeds quicker. But in conjunction with that vote, you're going to have the option to redeem. If that deal closes, you're going to be paid your pro rata portion of that trust account.
Wow. So, you mentioned March, and, we've had periods of times in the markets in the past where, the market's been quite volatile. And you mentioned, that there's some liquidity risk associated with that. So what happens to a SPAC typically in your experience when there has been a period where the markets may, take a big dive down in 1 month, like I think, March of 2020 or December of 2018, or the granddaddy of them all, kind of 2008, 2009. What would you see happen to a SPAC investment during that time?
Yeah, so it's really interesting. So December 2018, the fund was up in December 2018. We were pretty happy about that. And I think what distinguished 2018 from March 2020 was there was no real systematic risk or in the markets, and there was no systematic de-risking across all asset classes. That was not the case in 2020. And in 2018, the markets were under negative pricing pressure, but they were still functioning. And I think most people would agree in March, markets ceased functioning. There was, you couldn't get a bid on a 2-year RBC piece of paper if you owned it. That's not the market we transact in, but I saw dealers offering, 2-year paper at 8-9%, and you couldn't get a bid. That's not a market that's functioning. So in that liquidity strapped, over levered market, there was, correlations go to close to 1. Every asset class sells off, and there's a desperation for cash. SPACs were no different. The thing that, we take a lot of comfort in the product, and, we always talk about this, but you never know until it happens, is liquidity was actually there in March for SPACs. I think there was about, don't quote me on the exact numbers, but I think there was about 20 billion of SPACs outstanding in going into March. And the turnover was close to 50%. So, close to $10 billion of volume traded in between during that month. So while there was extreme pricing pressure and things were transacting at prices that nobody would want to be selling at, there was liquidity. So that makes us feel very good about the liquidity of the overall product. Now, when I say liquidity risk, well, what is that? That's putting yourself in a situation where you have to be selling in a time like March. That's when you can lock in and crystallize a loss. So, as long as you can, the beautiful thing about a SPAC is you're guaranteed your capital if you can hold through to the maturity of that SPAC. So as a fund manager, our first and most important job is never putting ourselves in a situation where we may have to sell at a deep discount to the trust value. And how do we do that? We run pretty conservative leverage, certainly, I think very conservative leverage, far lower than the credit that we have available to us. If you run with ample room on your credit lines, you can withstand quite a large market shock. We also, there's other things that you can do, multiple different prime brokerage counterparties, which we have, and things of that nature. But the most important aspect, or most important way you can protect your investors and protect from being a forced seller, is just not running maximum leverage, which we don't.
Right. Yeah. No, that makes sense. Although at this time in the cycle, and for the last little bit, a lot of the portfolio, is in SPACs, but the name of the portfolio is Merger Arbitrage Fund. So that leads to the second part of the fund, which is merger arbitrage. And a lot of people know, a company comes along, they get taken over by another company. That's a merger, pretty straightforward. But how do you make money on that in a conservative way? Because one of the things you've said is that, the fund is set up to be quite a conservative or defensive fund. How do you make money if you're betting on a transaction going through?
Yeah. So how merger arbitrage works, how the strategy works is, as you mentioned, company A is buying company B. There's going to be an announcement of a definitive merger agreement. That between announcement and close, there's going to be, some timeline, maybe 2 months up to maybe a year. But there's going to be certain hurdles, a shareholder vote, certainly, probably some regulatory hurdles. And then, each deal is different, but there's going to be some other conditionality. So why would no market participant would pay, let's just say the transaction, it's going to be a $50 takeover. No one would pay $50 to just get $50 in 4 months. So there's going to be a discount for participants like ourselves to put up that capital and then take that risk of a deal failing and going back to, let's say it was trading at $30 prior. So there's a $20 premium. So how merger arbitrage works is we come in and we make that last bit of spread by underwriting the risk of the deal. So what we've always focused on is very, very low conditionality, low regulatory risk, high probability of closing. And oftentimes that means lower return, but the lower return more than compensated, in our opinion, by the low conditionality. Very often when you get into a deal, you're going to know what the potential sticking points will be. We'll never speculate on HSR approval or US antitrust. That's just, in our opinion, we don't have the ability to gain a competitive advantage speculating on antitrust approval. I don't know if anyone can really gain a competitive advantage. Certainly we cannot. So what our portfolio has really evolved to is SPACs and opportunistic merger arb. So when I say opportunistic merger arb, that might be as simple as, a Canadian domiciled REIT being taken over. There's oftentimes punitive tax consequences for any non-Canadian fund to own that into the corporate action, into the deal closing. So that will lead to a bit of a premium in the spread, not because there's underlying, greater underlying transaction risk, just there's a structural inefficiency that we're able to capitalize on. So we'll come in, we're attracted to that. There's, other transactions, maybe smaller cap gold, that we think there's some structural inefficiencies in there. There's one we wrote about in our letter last month that had a nice, we were buying it at a positive spread with two competing deep pocket bidders. To us, that's just mispriced. That happened again previously this year. Guyana Gold, there was 3 bidders and it consistently traded at a positive spread. So I don't think we're necessarily remaking the wheel in merger arb. We follow it. We think there is individual mispricings, but on the whole, we don't think it's we're not allocating broadly to the asset class.
Right. Yeah. So you've painted a really good picture of how things go in this space, both with SPACs and merger arb. Why doesn't everyone just do it?
Well,
Not to put you on
I
the
think
spot,
I've been on the spot the whole time. Why doesn't everyone do it? Well, I mean, one, there's a lot of infrastructure. There's a lot of investment horsepower that goes into both strategies. You can't just, Davy Day Trader or Robin Hood the strategy. There's a lot of analytics that go into it, and it's a very active market, both SPACs and both merger arb. There's a lot of different aspects of the SPAC market too. Like, are you able to get allocations in new issue IPOs? You have those relationships with maybe the better underwriters. Do they trust you? Do they know you as an account? There's a lot of nuance around the strategy, and then a lot of actually just investment horsepower around the strategy as well that's needed to run it properly, limiting volatility, protecting capital, but also generating a nice return.
Right, cool. So what's, there's a lot of change going on, and there's always a lot of change going on in the world. Different governments, different natural disasters, different pandemics. Seems how does the external risks that we see in the market kind of affect what you guys do?
It's very interesting because we like to know what we don't, we like to accept what we don't know. And that's a lot. COVID is a perfect example. COVID was an extremely stressful time for the fund in March. We were able to weather that storm nicely. We didn't have to sell any securities. We held through and everything got dragged to par. But out of COVID, it actually made SPACs a massively attractive route to go public for private companies. And obviously, there was also a ton of euphoria coming out of COVID because of the stimulus checks and retail trading. And so I couldn't have foreseen COVID having the impact that it did on the back end. I guess you could have foreseen how aggressive the sell-off would have been in March. But, we try to just keep it simple, get back to our investment process, continually run that investment process. The most important thing we can do, our number one job, is make sure we don't have to force sell any securities at discounts to trust. If we can do that, then we've done our most important job. And then what does the upside scenario look like? I really don't know. We're very positive on the asset class, as you would expect. There's a lot of really high quality sponsors coming to market, whether it's, Reid Hoffman, the co-founder of LinkedIn. You have General Catalyst coming. They've, effectively created Livongo. You have Dragoneer, very, very highly respected VC tech hedge fund, high growth hedge fund. And, so there's a lot of positive signs, and, you're also seeing really high quality companies. DraftKings, for example, come public via SPAC. Nikola was a tremendous success. That's had some hiccups, but it's still, well over $20. So you're seeing some really high quality outcomes, both sponsor wise and back end. So we're positive. There's a lot of, even Barry Gurley wrote, Bill Gurley. I was thinking of another transaction. Bill Gurley wrote, from Benchmark about the attractiveness of SPACs to go public, and how it's actually more attractive for a lot of mid-stage to late-stage growth companies, more attractive than the regular way IPO. So we're positive in general, but does that really go into our investment philosophy? Not really. I think that's a beautiful thing about a SPAC is you don't have to worry about the upside. The upside is going to be what it's going to be, and you're going to be a price taker in that scenario. So you worry about the downside, you worry about making sure you guarantee a certain rate of return, and then the upside will be what it will be, and that's not really in your control.
Right. Well, thank you very much, Sean. That was a really good discussion of, a couple of topics that, a lot of people might not have the expertise or haven't read about lately. So, really appreciate your time. And
Sure.
we're really focused at Starratt Wealth Management to provide these types of ideas and these types of managers like Sean and his team to the retail and institutional investor to ensure that they have their goals met. And we specialize in this area. So definitely, if you have anybody who you'd like to talk about, from an investment management point of view, we'd be more than happy to listen. And as well, if you would like to discuss these strategies or any of our strategies at Starratt Wealth Management, please get in touch with us through our website at www.starrattwealth.com or give us a call through our phone number that's on the website. Thanks again, and thanks again, Sean, and we'll talk to you soon.
Thank you, Scott. Appreciate it.